On Monday, October 19, 1987, the Dow Jones Industrial Average fell 508 points to close at 1,738.74, a one-day decline of 22.6%. It remains the largest single-day percentage drop in the history of the index. To grasp the scale, the S&P 500 fell 20.47% the same day, its own worst single session ever. Worldwide losses were estimated at roughly $1.71 trillion, an estimate equal to about 35% of U.S. output that year. Crashes need height to fall from. Between August 1982 and August 1987, the S&P 500 tripled, rising from 102.42 to a peak of 336.77. The Dow climbed from 776 to 2,722 in the same stretch. By the late summer of 1987, a growing chorus feared stocks were simply overvalued and due for a correction, set against persistent U.S. trade and budget deficits and rising interest rates. The fuse was lit by genuine news the week before. On Wednesday, October 14th, the House Ways and Means Committee filed legislation to eliminate tax benefits for debt used to finance corporate mergers, which undercut the value of takeover target stocks. The same day, the Commerce Department reported an August trade deficit well above expectations, pushing the dollar down and raising fears the Fed would tighten. The Dow fell 95.46 points that Wednesday, 57.61 on Thursday, and a then record 108.35 on Friday. By Friday's close, the S&P 500 was down more than 9% for the week. The economy was sending real warning signals. Then policy coordination appeared to break in public. Over the weekend of October 17th and 18, Treasury Secretary James Baker was reported to have clashed with West Germany over the Bundesbank raising interest rates, and to have signaled willingness to let the dollar fall to narrow the trade deficit. According to standard accounts, investors outside the U.S. read this as a threat to devalue the dollar. Panic spread before the New York Stock Exchange could reopen, and heavy selling appeared first in Asian markets. To understand why an ordinary slide turned violent, you need a strategy almost no retail investor today has heard of. Portfolio insurance, commercialized by UC Berkeley professors Hayne Leland and Mark Rubenstein with partner John O'Brien, promised to put a floor under losses by automatically selling stock index futures as prices fell. It was designed to protect, but by design it sold into a decline. By October 1987, an estimated $60 to $90 billion of equity was hedged this way, much of it primed to sell at the same time. Here is the mechanism the Brady Commission later put at the center of its findings. Falling prices told the portfolio insurance models to sell S&P 500 futures. That heavy selling pushed futures below the value of the underlying stocks. Index arbitrage traders then bought the cheap futures and sold the actual stocks on the exchange through the automated DOT system, transmitting Chicago selling pressure straight into New York shares. Those lower stock prices triggered still more portfolio insurance selling. An initial decline, driven by real news, was caught in a vicious circle that fed on itself. On Monday morning, the plumbing failed. By 10 a.m., a massive sell order imbalance left 95 of the S&P 500 stocks, about 30% of the index by value, still unopened, and 11 of the 30 Dow stocks opened late. The futures market in Chicago opened on time and fell freely. That left stale cash market quotes sitting next to a plunging futures price, widening the gap and feeding the arbitrage loop. Order volume overwhelmed the computers and trade executions ran more than an hour behind. This was not millions of panicked individuals. The selling was extraordinarily concentrated. The Brady Commission found that just 3 portfolio insurance strategies accounted for nearly $2 billion in stock selling, and about 10 other institutions added roughly $1.5 billion more. In the futures market, portfolio insurers conducted about 40% of non-market maker selling, and the top 10 sellers made up roughly half of that volume. One institution alone sold 13 blocks of just under $100 million each, about $1.1 billion in total. Around 1 p.m., SEC Chairman David Reuter was reported to have raised the possibility of a temporary halt in trading. He later told Congress his remark was misinterpreted, but at the time it sparked rumors the exchange would close, and traders sold harder rather than risk being locked in. The Brady report found that with arbitrageurs withdrawn and buyers gone, the Dow sank almost 300 points over the last hour and a quarter, including about 220 points, an 11.2% drop in the final hour alone. The day ended on 604 million shares, the exchange's first ever 600 million share session. The selling swept every time zone. Hong Kong fell about 45.8% and shut its exchange for the rest of the week. Australia and Singapore each fell more than 40%. The UK FTSE 100 dropped about 23% over 2 days. Japan's market fell nearly 15% in a single session. Standard accounts attribute this synchronized global rout to shared overvaluation, the dollar policy fears, cross-border panic, and capital flows and program-driven selling working together, rather than to any one national economy. The most dangerous hours came the next day. The Brady report concluded it was midday Tuesday, October 20th, that the securities markets and the financial system approached breakdown. S&P 500 futures went into freefall again, dropping about 27% between 10 a.m. and 12:15 p.m., to a level implying a Dow near 1,400. The futures market halted trading from 12:15 to 1:05 p.m. and 175 individual stocks were halted. Margin calls ran about 10 times their normal size, and rumors of a clearinghouse failure, later shown to be unfounded, nearly froze bank credit. Alan Greenspan had been Fed chairman for barely 2 months, sworn in that August. Before markets opened on Tuesday, he issued a single sentence. The Federal Reserve affirmed its readiness to serve as a source of liquidity to support the economic and financial system. Then it backed the words with action. The Fed ran open market operations more than an hour early, pushed the federal funds rate from over 7.5% down towards 7%, and injected about $17 billion in reserves on October 20th. The decisive move was getting banks to keep lending to securities firms so the clearing system would not seize. New York Fed President E. Gerald Corrigan personally telephoned top bankers. After one such call, Citicorp's lending to securities firms jumped to $1.4 billion on October 20th, up from a normal $200 to $400 million. The message, as one banker recalled it, was that whatever the firms needed, the banks would provide. The Fed also loosened limits on lending Treasury securities and extended Fedwire hours. Here's what makes 1987 stand apart from 1929 and 2008. Helped by the Fed's backstop and by more than $6 billion in announced corporate buybacks, the Dow regained 288 points, about 57% of the Black Monday loss, in just the next 2 trading sessions. On a price basis, both major indexes still finished 1987 positive, the Dow up about 2.26% and the S&P 500 up about 2%. There was no U.S. recession and no banking crisis. The market regained its pre-crash high by July 26, 1989, when the S&P 500 again reached 336.77. By most expert accounts, this was driven far more by market structure and panic than by a collapse in the real economy. President Reagan created the Brady Commission on November 5, 1987, and it delivered its report in about 60 days. Its central finding was that stocks, futures, and options are in fact one market, linked by strategies and clearing, but were being regulated as separate markets. The fix that endured was the circuit breaker. In October 1988, the NYSE adopted Rule 80B, halting trading after a 250-point Dow drop and again after 400 points, then about 12 and 19% of the index. The circuit breakers born from 1987 are the ancestors of the ones in markets now. They were rebased on S&P 500 percentages effective February 2013, with halts at 7, 13, and 20%, and they fired 4 times in 2 weeks during the March 2020 COVID crash. But the deeper takeaway is historical, not a tip. In the moment, even professionals struggled to tell a structural panic like 1987 from a fundamentals-driven decline like 2008, when the Dow lost about a third of its value across a year-long recession. The history simply shows that in 1987, the fall reversed about 57% within 2 sessions, a reminder that no one can reliably time the bottom of a panic.